I'm Larry Ray, President and CEO of American Manganese, Inc., listed on the TSX Venture, ticker symbol AMY, A-M-Y, with proprietary patents in the U.S., China, and South Africa. Our focus is on recycling lithium-ion batteries for electric vehicles. China recently legislated the responsibility for recycling onto their electric vehicle manufacturers and importers. For more information, please visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from thewealthyhomeowner.ca. Welcome back to the show, Ross.
And thanks for having me back, Jim.
Ross, last week CMHC released a massive report on the Canadian housing market from 2010 through 2016. It was a report that was 200 pages long. It explained how house prices rose over that period. For instance, CMHC stated that prices in Toronto had increased 40%. The research showed 8% was because of a young population, 5% because of real income growth, 3.2% caused by falling interest rates, leaving nearly 24% of that to something they could not explain. They don't sound like they're real experts to me if you can't explain 25% of something. What are your thoughts on this massive report?
Oh, okay. Yeah, I agree with what you're saying. And the irony of being given $250 million extra in from the federal government to be able to do adequate research on housing. I think that this report in itself that you're referencing, Jim, this report is the result of that $250 million extra on top of what CMHC was already getting yearly. The government dedicating towards CMHC in terms of trying to understand the housing market more. Now, can you imagine spending $250 million and getting back a report that says that of the 40% increase in house prices have gone up 40%, we can account for less than half of that amount. In other words, using 24%, there's 24% of the 40% that we can't find. It's just lunacy.
Well, where did that money go? Where did it come from? Who had that money? Who spent it? Aren't they supposed to have formal documents to keep track of all that?
The documents that the Canadian public only needs to know about is the $4.5 billion that CMHC gave to the federal government after it was elected. Those are funds that no previous government in the history of Canada ever received from CMHC. Those monies previously were always stored at CMHC to allow for a prudent management of the mortgage default insurance program. But I guess the promise of $250 million back to be able to spend on wages and employment and everything else that CMHC can think about was just too much to allow for a prudent overview of the entire CMHC to take place. When we look at this report, Jim, when they comment about house prices have gone up 40%, and we've told your listeners over and over again on your show, it is the average purchase price paid. It has nothing to do with the average house. If you looked at the average house that was selling at the beginning of this report, which was the first quarter of 2010, that's over 5 years ago, 5 years from the end of the report, which was the second quarter of 2016. It's not even the same house. The house that's being purchased in 2016 is a totally different house that was being purchased in Toronto back in 2010. So that comment wasn't even included in their research. Their research attributed a 3.2% increase in prices from 2010 to 2016 being because of falling interest rates. Even my lowest skilled housing analyst that works with us here They'd laugh at a foolish comment like that, because the percentage difference is substantially higher than that. We can account for all 40% because it's that simple. Number one, the mill rate on property taxes in the city of Toronto dropped each year from 2010 to 2016. If you're measuring a $425,000 house in 2010, and you are now measuring a $745,000 house in 2016, which is what they did in this report, because they used the Canadian Real Estate Association numbers, once again being so ignorant they continue to use Korea data. When you take that spread into account, and you take into account the interest rate change over that period of time, that alone equates to about 14%. Excuse me, we're talking property taxes. The property taxes alone eat up about 10% of the difference. Okay, so now we're down to 30%. Where's the rest of the 30%, Ross? Well, when you look at the cost of a home, how much someone is able to pay for it, you have to look at what the monthly payment is for that home. These monthly payments have followed the same pattern since the 1950s until today. Your listeners would be shocked to learn, back in 1951, 32% of Canadian homeowners had a mortgage. And in 2017, it's virtually the same. It has not changed. It never changes. So what that means is that when you have to start applying the interest rate differential, you have to apply it against how people buy houses. They buy their houses based on a mortgage payment, plus your property taxes, plus a small portion that has to be dedicated for heat and hydro. That is your mortgage qualification. That's what's required. Okay, so that payment definitely has gone up, even though interest rates have fallen. Remember, interest rates only account for a certain portion of this. Property taxes have dropped. In other words, if a person was purchasing a $700,000 house back in 2010, and they purchased a $700,000 house in 2016, they're paying less property taxes. That property tax component is one of the biggest factors that changes housing prices across Canada over the course of a short period of time. Short period of time, usually your window's less than 10 years. So you have that. Now, you also have to understand is that home buyers are generally the people who are lucky. They're the people who have gotten raises over the last 5 years. And even if those raises just went up with inflation, in other words, they really didn't make any money, but they were given a raise just with inflation, that offsets the mortgage differential totally. 100% eradicated. So we're sitting here looking at rising income level able to service debt, because we know which Canadians buy homes. The same person in 2010 that was buying a home is the same type of person in 2016. Both people who are getting regular wage increases at the start of the year. You also have to take into consideration inflation itself when you're talking about house price change, because inflation clearly has some impact on those prices. Our calculations don't even need to use inflation to show a 100% of the 40% that CMHC is citing we can account for, just in those three variables we just talked about. CMHC said we can't account for over half of the difference. In other words, 23.8% of the increase has taken place. We can't find that 23.8%. I just told your listeners exactly where that increase is. When we're commenting about a housing market, we comment about a housing market because of how it functions. I've said that on your show over and over again to your listeners when they come back and they say, but Ross, this is what we're seeing in the marketplace. Yes, what you're seeing in the marketplace was already recorded a year and a half ago. What you're seeing is the consequence of what we recorded that period of time. CMHC can't even look at a small window of 5 years, 6 months, and figure out why prices went up 40% in Toronto. And then when we look at over at Vancouver, it's the exact same thing. Now, what's unique in Vancouver is we know that there were foreign buyers, and we know that artificially inflated the benchmark price produced by the real estate boards. That allowed more house price illusion to take place. It also meant that the percentage of sales going to Canadians was dropping. That means the percentage of sales that were being recorded, inflating the price, were to foreign buyers. You had to account for that in your numbers. CMHC did not account for that in their numbers. We also know that in both Toronto and in Vancouver, there was a period of trading cycles over this period of time. In Toronto, the period that they referenced, there were actually 4 different trading cycles that were ongoing during that period. In Vancouver, there were only 2. So you have to take that into consideration when you're measuring house prices, because that tells you how the buyer mix moves. And since the buyer mix messes with the average selling price, which is what CMHC used in this massive, massive report, and they didn't compensate for it, they're always going to be wrong. What I can tell your listeners is this. When CMHC makes news headlines talking about the housing market, other than when they reference homes completed, don't listen to them. And I know how absurd this comment is that I'm making to you right now, Jim. Because how is this possible? This is simply the truth. These people get caught time and time and time again making mistakes, and no one holds them to account. They've been just given $250 million extra to study the housing market, and they produce this mammoth report that we can debunk virtually every single page. Now, mind you, my staff does not have the time to go through a 200-plus page report and debunk every page and give out that information to the government at no charge. That just makes no sense to my business. So I just prefer to come on this show here and explain to everybody how we accounted for the 40% difference that Toronto housing prices have gone up. And we've just accounted for 100% of that 40% increase that they talked about.
Ross, well, what I can say is I think the federal government should fire CMHC and give you that $250 million and get some accurate numbers for their money.
Yeah. But then it would look like that's what we're hearing, what I'm doing here in the show. No, I have given CMHC, when you have the new mortgage rules that you have in place here, that happened. Those rules came into effect after my firm sent the OSFI, Jeremy Rudin in particular, an email telling him that the gross debt service ratio was the problem for the housing market, and that because they did not create a variable gross debt service ratio way back in the 1980s to monitor, to determine how much mortgage debt someone could take on, you've allowed consumers to take on more mortgage debt. Now, there's nothing wrong with the mortgage debt they've taken on, I'm not being critical of that. But you have allowed realtors to use that to manipulate the public and the banks. And that is exactly what they did. So when the OSFI came back in with the new stress test, raising the interest rate to the posted rate, all they did was they lowered the gross debt service ratio. And by tying it to the interest rates, the posted rate, they also made it variable, because the spread in your monthly payments as you go forward with higher and higher interest rates is going to drop because we'll only have to look at the posted rate versus the discounted rate that you're able to get. Since you're no longer being qualified at the discount rate, you have to qualify at the posted rate. But when rates get back to 6, 7, 8%, your monthly payment spread between those two rates shrinks. And when you get out to 9 and 10%, it's virtually the same. So what the government did was they created a variable GDS ratio, which was the exact thing that my firm brought to the attention of the OSFI. They said thank you in their response, but they also didn't give us credit when that happened. Now, in that particular instance, I'm glad they didn't give us credit, because everybody was going around telling everyone else, the mortgage brokers, the banks, the realtors, how this was going to kill the housing market. And I thought, oh, great, here we go. They're going to say, oh, well, we got this information from Ross K. Realty Consultants. We're happy that we didn't look at it this way. This is a new perspective. Yes, we should have had a variable gross debt service ratio, and we're making that change today. Housing market crashes, oh, blame it on Ross K. When I started this, way back in 2013, when I started talking publicly about housing markets, it was on with Garth Turner. And at that time, I was so afraid of that the truth was going to bring the market crashing down, I had to be careful with everything that I said. So on Garth's site, if people go back there, they can go back to the 2013 article, blog post that he posted when he was quoting what I was saying, and you'll see back then that I said it was peak price. Houses had peaked with price. I also went on to say further that you can expect in the following months that prices were going to drop. Well, what happened was the Canadian government dropped interest rates. So my comment about housing prices are going to drop never took place. But what did happen was peak price was set. You measure peak price at the start of a trading cycle and at the end of a trading cycle. At the start of the trading cycle, first-time buyers' peak price is measured. That's why if any of your listeners go to the CMHC website and you look at the the third quarter data from 2013 from CMHC's own reports, and you look at the third quarter data in 2017's CMHC reports, you're going to see that when you take the mortgage amount that first-time buyers were taking out in 2013 and 2017, and you check the payment they'd be making at the interest rate that CMHC also publishes, it's the exact same payment. It's $1,200 a month. Meaning, first-time buyers' peak price was reached in second quarter 2013 when that $1,200 per month was reached. It's actually $1,287 or something of that nature. I'm saying it could be 2017. 1217. I'm talking off the top of my head here, Jim. That peak price was reached then. You also have peak price on the other end, which in Vancouver was March, April of 2016, and which was in Toronto, which was in March, April of 2017. Those were peak trade-up buyer prices. Now, the first-time buyers have never paid any more. They have remained exactly the same from 2013 to 2017. Their monthly payment is exactly the same. Trade-up buyers kept increasing in the payment that they would pay because there had to be more steps in the property ladder that skewed the average selling price that booked more mortgage debt. That price cannot be hit again, people. It's going to take a full trading cycle for that ever to happen again. And that would only be if there's no correcting or no contracting market. That's not if the interest rates don't rise. Interest rates are already rising. Ross, our housing price is going to keep going up. No, it is impossible. Yes, you will hear average selling price and benchmark price reported as going higher. But if you look at the exact same house, you won't see that. And that's why CMHC is never going to be sending out a letter to employ us, Jim. It's because every single economist, academic, housing analyst that works at CMHC is ignorant to the housing market. They just got $250 million extra to pay everybody. There's no way they're going to admit they've been wrong for the last 50 years.
We'll have more with Ross Kay right after the break.
I'm Greg Johnston, CEO of Carl Data Solutions, an industrial Internet of Things company that provides big data solutions for monitoring critical infrastructure. Carl Data offers machine learning and predictive analytics features through our cloud-based applications to deliver key asset-saving operational insights from massive amounts of data. Carl Data trades on the CSE, symbol CRL, and the Pink, symbol CDTAF. For more details on Carl Data, please visit carlsolutions.com.
I'm Bill McWilliam, president of Cascadero Copper, CCD on the TSX Venture Exchange. Cesium is one of the world's rarest metals with a growing industrial demand. Drilling is underway on our Tehran property in Argentina to prove up a cesium resource. Cascadero's patent-pending leach process has the potential to make Cascadero the lowest cost supplier of cesium in the world. Visit our website, cascadero.com, or phone us at 604-924-5504.
Welcome back. We're speaking with Ross Kay. Ross, a reader emailed the following. Ross says housing in Vancouver last year did not increase by 30%. I guess he is not including condos in that statement. Condos have increased that much and more. What exactly is Ross saying?
What exactly is Ross? I'm saying the same thing, listeners, that I've been saying on this show since 2016. Your housing market has already corrected by 30%. It takes a long period of time for the damage to be done to be recorded. The first side is single detached homes. The houses that are the more expensive the houses, the bigger the correction that can take place. These more expensive houses that are also dumps are the first ones to take a decline in price. I can find example after example of houses in Vancouver that you can purchase today for 40% less than what you would have had to pay for them in July of 2016. That's large single detached houses. They're virtually teardowns, Jim. They're houses where people normally buy a lot. I saw an ad the other day where somebody was joking about, oh, this is the house you get for $1.7 million in Vancouver. And just that, I hate even seeing those ads, even though they're funny. It's because what you're really saying, there should be no house there. You're buying a vacant building lot. As a matter of fact, you're probably going to have to pay $4,000 to $5,000 to tear that house down. So there's a little tiny adjustment you got to make to get rid of the house in the first place. In other words, the lot would be worth about another $4,000 or $5,000 if that house is already gone. The land to house ratio, the land to building ratio, is a very important metric that we use to measure housing markets. We're tracking these in the background with our own metrics all the time. We have to continually update these. They are very complex calculations that you have to be registering, because you have to compare the best house on a lot against the worst house on a lot, calculate the difference in selling prices. Then you also have to calculate what you're able to build on that the lot with the crappy house on it that you're going to tear down. And from that, you have to extrapolate what your land value is. These land values are constantly changing. Land value really is the only component in a house price that really changes, Jim. Other than the quality component, the land price is really where all the change is taking place. When CMHC in that report said that house prices have gone up 40%, hogwash. Land prices have gone up 40% is what they're saying. The buildings have not gone up at all in price. There would be a small increase in the building cost, because the same house that was being purchased in 2016 was not the same house that was being purchased in 2010. I'm sure any of your listeners would understand. If you bought a house in 2010, houses that were built in 2011, 12, 13, 14, 15, 16 didn't even exist. So it was impossible to buy the same average house. Home buyers, Jim, also always seek out the highest quality they can purchase for their monthly payment. It's the way cars are being sold today. Cars, 7 years ago were never sold with 7 year leases or 7-year GMC financing. Now 7 years is common across all the brands. I'm hearing that in the luxury brands, they'll lend you money to buy a car over a 10-year period. Okay, that's because they're not able to sell the cars at the prices that they're building them for. So they have to inflate the price and work it via the financing route. People wouldn't pay what they have to get for some of these luxury cars. That's exactly what happens in the housing market. People purchase a house based on a payment. That's how they buy. Every single house I have sold, well, not every single, 99% of the houses that I sold over my career, that my parents sold, that my great uncle sold, they were all sold based on a simple monthly payment. That payment is does not change with the house. The payment changes with the land. You can take a condominium building. Let's say you've got a condominium building. You've got this in Vancouver right now. There's a large portion of Vancouver that's being redeveloped, and they were lotting it. There's 2,700 new units going in. I think it was 371 of the units are going to be for social housing, and advocates were claiming this is a great cause. I look at it and I'm saying, wait a second. You're missing 700 to 1,200 social housing units that you could have had that builder agree to build for you. I also know that probably the city and the province and the social housing people are negotiating prices that are way too high. In other words, the builder is still going to get an astronomical profit margin. The builder is also going to reap the rewards probably of doing property maintenance, or one of their sub-corporations are going to do the property maintenance. So when you're saying, Ross, housing prices last year did not increase 30%, I say they didn't increase 30%. It's because I take all these things into consideration, folks. Your land values, which we call building envelopes. So at my firm, we don't call it land, we call it a building envelope. Because a condominium has a building envelope. And if you have a 20-story condominium or a 40-story condominium, the 40-story condominium probably has 2 times the building envelopes. If the builder pays $100,000 for an acre of land and he can build 10 stories on it, you can figure that he's paying $10,000 per floor of building envelopes. If he can all of a sudden build 20 stories, he's only paying $5,000 a floor for his building envelopes. If there are 10 building envelopes, 10 condominiums on each floor, that takes it to $1,000. Or with the 20-story, down to $500. That's how it works, folks. You're looking at these condominiums as condominium prices as if they're all the same. They're not. If the building is twice as tall, but you're paying the same price, let's say a builder builds a brand new building that's 20 stories high, and he builds another building that is 10 stories high. And he charges exactly the same size units in both buildings, same amenities, same features, identical units. He sells them both for the same price. The person in the 20-story building is paying way, way more for the land, for the building envelope, than the person in the 10-story. And that's what's going on in Vancouver right now. I understand that when you look out in the newspaper and you see prices are up 30% and you believe that housing prices have increased 30%. Well, you have to understand what's selling. How many floors are selling? How much does one building next to another, the one building that has 20 floors, the other one has 10 floors, if a brand new building with 20 floors is built and sells, how much does that impact the value of the building with 10 floors? All of those things have to be taken into consideration. With the number of condo closings that have taken place, you have to adjust for all of that. Now, has the same condo, the exact same condo, increased in value or in Vancouver over the last year? Yes, it has. Because the quality of the condo housing stock has increased. That's the way that it goes, folks. People have paid to improve their condos. They pay for that improvement in their condo fees. Or they renovate the kitchens. Or they redo the hardwoods. Or you have a special assessment. So yes, they have, and if they didn't, they were losing money. Now, if you're asking me, have they really gone up 30%? I'll say no. That's an outright lie. Because all you're seeing are the few units that sell. What you saw, which was really unique in Vancouver last year, and this was a real telltale sign that CMHC should have been following up on. Even their ignorance, they should have clued into this basic premise. If sales are falling, in other words, the number of condominiums selling in 2017 are less than the number of condominiums selling in 2016, how did you get a 30% house price increase? Because I'll tell your listeners this, in any other real estate market in North America over the last 50 years, that never happened. Why did it happen in Vancouver? It had nothing to do with regular Canadian home buyers. It had nothing to do with the same condominium year-over-year price change. It had nothing to do with anything the government did, including that first-time buyer assistance with the loan, the $37,000. It had nothing to do with foreign buyer tax. It had nothing to do with any of those things. It simply has to do with how the housing market functions. Until your full market correction is registered and all the financial damage has taken place to literally hundreds of thousands of British Columbia families, you won't know this is even going on. You're going to believe everything is rosy. Ask that to the owner, to the person who bought that tear-down $2.4 million house in Vancouver in the peak of 2016, who now realizes that they have to take a $600,000 to $700,000 loss if they're going to sell it again. Think about whether or not you can stomach that yourself. The beautiful thing about housing, the beautiful thing about home ownership is that inflation takes care of a lot of your mistakes. If you hold on to that house for 25 years, inflation is going to take care of any house price mistake you made buying it in 2017. Can you stomach that 25-year period? Because when someone says to me, Ross, how you kept saying housing prices didn't go up 30%, drop by 30% last year, and I see them increasing by 30%, it's because I don't have to sell you a house to make money. I make my money by giving you advice. If my advice is wrong for the little bit that you pay me, you simply won't pay me anymore. You simply won't come back for more advice. I don't get a $20,000, $30,000, $40,000 windfall just by keeping my mouth shut and letting you make the hugest financial mistake of your lifetime. I have to craft everything that I say here on this show so that the listeners don't take what I'm saying as black and white and go out and make a decision on it. Because you need some underlying understanding to what I'm saying. So for the listener out there who called in and said that about condominiums, yes, condominiums increased in price. No, they did not increase 30% in value. Yes, houses in Vancouver have dropped 40% and 50% in price. Some of the 50, I'd be hard pressed to find many, but 40s I can find lots. That is the truth. You just have to let the market work itself out. The builders don't want you to do it. The realtors don't want you to do it. And the bankers don't want you to do it. The three players who make all their money from you buying houses, from you paying more and more money, for you taking on more and more mortgage debt, all don't want to listen to Ross. They don't want to listen that this is simply a cycle. The cycle has to work its way out. The cycle always repeats itself. It's repeated itself as far back as we have reliable data. The cycle never changes.
We'll have more with Ross Kay right after this.
Cypress Development Corp's flagship lithium project is located just east of Albemarle's Silver Peak mine in the heart of Clayton Valley, Nevada. A 12-hole exploration drill program for lithium-enriched claystone on Cypress's 100% controlled properties is now underway. Cypress Development Corp trades on the TSX Venture Exchange, symbol CYP, the Pink's CYDVF, and on Frankfurt's C1Z1. For more information, please visit our website, cypressdevelopmentcorp.com.
Keep informed. Receive our weekly recap of thought-provoking articles, podcasts, and radio delivered to your inbox for free. Sign up for the HowStreet.com weekly recap on our homepage, HowStreet.com. Welcome back. We're speaking with Ross Kay. Ross, a simple question, but I bet you the answer isn't simple. How can a person know when's the right time to buy a home?
Well, for a lot of your listeners, the best time to have purchased a home would have been back in November of 2016, when interest rates were I could get you a 5-year interest rate at 1.99%. That, for a lot of you listeners, may have been the best time to buy a home, because you wouldn't have listened to any of the other advice I'm going to give you over the next 20 years. So by giving you that one piece of advice, at least I know I would have set you out on the right path to be paying down your mortgage as rapidly as possible by taking a 1.99% interest rate at a 25-year AM. The amount of money that you would have paid off in that 5 years is staggering. How can you determine the right time to buy a home? There are 3 questions that every home buyer needs to have. One is the truth. The truth is, I'll talk about in a second. The second is timing. You have to know when to get into the market based, or as we call it, time the market. You have to know when your specific category of home is accelerating in price or decelerating in price. If you want to buy a home in any particular, even in a particular year, you want to be buying it during the phase when it's most to your benefit as the buyer. So that's timing the market. And then we have terms. And terms are something that is never ever discussed when it comes to buying real estate. It used to be discussed a little bit in the 1980s when interest rates were went up to 23%. It used to be a little bit discussed in the 1960s when we had vendor take-back mortgages. It used to be discussed in the early 1990s when homeowners were willing to renovate a house for the new buyer because they couldn't sell the property in Ontario. Terms are what every home buyer never looks at because the professionals that you're dealing with simply have lacked the skill and the ability to negotiate terms. I know right now today, Jim, that if we were to call up 20 mortgage brokers randomly and ask them to explain the benefits of a vendor take-back mortgage, whether or not they could write a vendor take-back mortgage without talking to a lawyer, and how they could explain a vendor take-back mortgage to both the mortgagee and mortgagor, we would be lucky if we found one of the 20 that could do those things. Yet, in the next 10 to 15 years, that is going to be a highly important skill for a mortgage broker to have again, just like they needed to have it 34 years ago. The terms that you purchase a home under are really allow you to decide how much you should be paying for the property. Now, you can have a home inspection done, but the home inspector will not tell you fully what remedial work needs to be done in the property to bring it up to its current asking price, or even the price that you've offered in your contract. The building inspector is the starting point for any home purchase today, because that building inspector is part of the terms that you should be offering on that property. That property's terms are contingent upon what that building inspector finds wrong with the house, or right for that matter. The terms also look at financing. Does the vendor have in place, was the vendor smart enough in November of 2016 to take out a $1 0.99%, 5-year mortgage that was assumable for any new buyer. Because if that's the case, there are many buyers out there right now who would love to assume that mortgage. That makes the property more valuable. When it comes to terms, there's a whole bunch of features that are involved in terms. It's a complicated process that the average home buyer should not even worry about. You should be letting a professional take care of it. Unfortunately, terms are something that nobody in the real estate marketplace right now deals with other than my firm. Timing the market. These are the 3 T's. There's 3 T's when it comes to home buying. Terms, time, and trust. Timing the market. You want to make sure that you're buying your property at the right time of the year if you're going to buy it in a calendar year. Okay? There is no sense for a single detached home buyer to be purchasing their home in certain months of the year. There are other months of the year where it's a prime time to be done. This is the same thing with the condominium buyer. Different price categories of buyers. They all change over the course of the year. Find that in writing anywhere, your listeners. Your listeners, I encourage you, go out and find one realtor that tells you which time of the year you should be buying a house. Which category of house should be purchased, and which months you shouldn't be buying a house, and which category of house shouldn't be purchased in those months. And then try to find one who knows how the trading cycle works and understands this doesn't work January to December. This changes over every single trading cycle. No 2 trading cycles are the same. So those months change. Okay, that is how you time the market. And then you have trust. And trust is the hardest thing for any home buyer to have, Jim. Trust is the hardest thing that anybody can find. Because trust means a couple of things. One, the house that you're buying, you're trusting that the terms that you were given on that purchase were what you thought they were. 2, trust that you're buying the house at the right time of the market. You're timing the market correct. Trust 3, the person you're getting your home buying advice from, you can trust. They have no skin in the game. They cannot financially benefit from giving you any advice. Right now in Canada, the only advice any home buyer will get is buy a house. It's always a great time to buy a house. CMHC has said that, or the Canadian Real Estate Association has said that for 40 years. Any time's a great time to buy a house. No, it's not. Any time is a great time to own a house, but every time is not a great time to buy a house. You need to be looking at timing the market, you need to be looking at the terms, and then you need to be looking at trust. Trust also applies to the price, because there is nowhere out there, anywhere in North America. I encourage your listeners to do a thorough Google search, where anyone selling real estate forecasts the future price of the home you will be buying. It does not exist. It has never existed, ever. The only place where house price forecasts are provided is at the wealthy homeowner. It does not happen anywhere else. This is a brand new, well, a couple years old now. This is a brand new calculation. When someone is using our buying program, we give them a price forecast on their house over the next 1, 2, and 5 years. If we are wrong, their buying program fees are refunded. On top of that, their buying program fees were refunded through the program anyways. So they actually get a double guarantee on what they were paying. They pay nothing for our program, and if we were wrong, they get the money back again a second time. Time, trust, terms. Terms, trust, time. I don't care what combination you put those 3 T's together. In order for you to determine whether or not it is the right time for you and you alone to buy a house, you need to have your 3 T's covered. And only then should you be making the largest financial investment of your life.
Ross, thank you so much for your time and trust.
Hey, thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. You're listening to HoweStreet.com radio. Find us on Twitter at HoweStreet. Our YouTube channel is Talk Digital Network. Questions for the show or our guests, like Ross, can be sent to info@HoweStreet.com. I'm Jim Goddard. Thanks for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.